Tim, looking specifically at the UK market, what do you see as the prospects for the retail sector?
Well, we're fairly buoyant and optimistic about 2015, unlike some of the corporate market, which is perhaps worried about what's happening geopolitically around the world, the uncertainty of a forthcoming election. The one thing we have in the retail market is consumer certainty, and consumers feel that they've got more money in their pocket, they feel they might get a pay rise, they're feeling wealthier, and that benefits retailers.
In the UK, obviously, the headlines have been focused on Tesco's particularly. How do you see the prospects for the food retail sector in general in the UK?
2015 is a transitionary year. We're going to see a fight back from the big four, not least Tesco's, but they still hold 28% of the UK grocery market, and together with their main rivals, Morrison's, Sainsbury's and Asda, they hold 75% of the market, and they're not going to let go of that anytime soon. And there's been a lot of commentary in the press and generally, especially with analysts, about the rise of the discounters in all retail sectors, but particularly in retail, and particularly Aldi and Lidl. But they only own 8% of the market. And yes, it's grown very quickly over the last 12 to 15 months, but it's really, really slowing. The reasons that we are predicting that the big four grocers in the UK will be able to fight back compared to the discounters is they've got other places to go. Yes, the discounters are discounting, they're investing in price. The big four can all do that. They've got huge pockets, but it's not just about price investment. It's also about provenance, it's about good service, and it's about variety. And the big four can offer that, the discounters can't.
One of the key things to hit the market this year as well will be the re-rating of business rates. What sort of impact do you think that will have?
2015 is an absolutely key year in terms of retailers being able to establish what their costs are going to be moving forward. 2015 is a revaluation year. The antecedent date or the payment date will be 2017, but values and costs will be set this year. And that's going to be great for a majority of the retailers who have been suffering by paying rates which are too high. But there is a sting in the tail for those retailers who have benefited from our lethargic 5-year system, not least London, where streets such as Bond Street and areas such as Covent Garden have seen rents grow by as much as 100% since the last revaluation. And it's not just London. There'll also be a sting in the tail for areas in the country or sectors such as restaurants and the food superstores themselves. Our calculations have showed us that Morrison's, Sainsbury's, Asda and Tesco might be seeing rises up to £100,000 per property on the back of this revaluation because rents have risen in those sectors over the last 5 years.
Looking at sort of general key trends in terms of retail, how do you see convenience retail as opposed to shopping centres?
Well, it's interesting you say that because our third prediction for the year is based on convenience. Research shows us that people shop on average for only 37 minutes a day. That's online and offline. So that's only about 4 hours a week of attention that we have to grab. Therefore, if retail isn't convenient, it's inconvenient. And therefore we predict that convenient retail should be able to attract some price premium because consumers want to shop there, retailers will want to occupy it, and investors should want to buy it.
And how do you think some of these themes will play into the investment markets?
I'll look back at 2014 for a bit. It was a huge year, it was a record year. We saw £65 billion worth of property traded. Now 2007 was 63.5 billion. It's not far off, but we've just seen a record year. Going forward, there isn't much that's going to change to stop that. Yes, we've got a general election, and historically we've seen general elections stall things, but we believe that will be a short stall and that the weight of money in the market and the fundamentals will mean that property investment carries forward. On the retail side, people are going to be very selective. We think an absolute prime yield, there'll be a race to go for the very, very best. But the interesting place is the secondary market, where we think there'll be a polarisation between sort of prime secondary and proper secondary. Prime secondary being those areas that can be properly asset managed, where you get a bit of yield, that will be attractive to people borrowing money, smaller investors, and real secondary being something that people want to avoid because there is no solution.